Sean Fenton now. He's a portfolio manager for Tribeca Investment Partners. And Sean joins us this morning from Sydney. And Sean, first off, let me get your reaction to what we're seeing on the markets. Not surprising to you, considering what we got in the jobs front in the U.S. on Friday.
Yeah, not surprising at all, considering we'd had a reasonably strong week last week, so a little bit of profit-taking, confirming what we knew, that the US economy really had slowed down in the last quarter, and with all the political uncertainty, really hit a bit of a wall in August. So yeah, zero net job growth there. But I think the interesting thing also is during the month you saw pretty solid new jobless claim numbers, not really blowing out too much, which indicates it's not so much people laying off, but just indecision and not hiring. So certainly reinforcing that soft patch.
Okay, soft patch, right? Not double dip.
Yeah, look, it's a very tricky one at the moment because there's certainly been a lot of headwinds. You've had the Japanese tsunami, you've had floods in the US, a natural inventory liquidation. But when we've hit this political gridlock in the US and with the uncertainties in Europe, the real question now is, does that soft patch extend further? How serious has been the impact on confidence, both to businesses and consumers? So I think people are going to be very sensitive to the high-frequency data coming out, trying to get a feel for whether business is moving back to normal or we are moving into a double dip. So that risk is certainly out there.
Well, Sean, okay, risk of double dip, is it worth maybe picking up on some bargains here, considering we have seen stocks bounce back from low levels?
Yeah, look, certainly we've had a big risk-off trade, and you've seen that impacting right across sort of minor commodity-type stocks. Seeing that today, BHP's ex-dividend, but BHP down, Rio's down. I think there is value emerging there because we are seeing now increasing focus on how do authorities react. What's the reaction? QE3 comes into the picture. Further quantitative easing in Japan, and importantly what China starts to do is we potentially see inflation there peak out. How do they respond to slowing growth in their export partners? Do they take their foot off the brakes? And I think that's what's really more important to commodity prices. So we do see pretty good value here across the mining sector, right from the commodity players down into the mining services. So yeah, we like Rio Tinto, we like Incitec pivot across agricultural fertiliser space into the mining services stocks, companies like Bradken, Boart, all offering pretty good value at the moment.
Okay, well, Sean, how about this? How confident are you that we will see stocks higher at the end of this year?
I'm actually reasonably confident that it will be high. We are coming from extremely oversold levels, so in a lot of valuation metrics comparing equity markets, not just in Australia but all around the world, to government bond yields and corporate bond yields, they are at very cheap levels, probably cheaper than they were in the GFC in many cases, reflecting extreme risk aversion. So to the extent we don't actually see a blow up in the European banking system, there's a fair chance that markets will start to normalise and move higher. So I'm fairly confident, but you can't be completely confident in this environment because Europe in particular does represent a very fluid and unstable situation.
Yeah, absolutely, especially as we have the Italian Parliament today talking about budgets and whether or not we'll actually get a shortfall. That's a big concern in the markets right now. Sean, thank you for your time. Sean Fenton joining us from Sydney.